Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SoundHound AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really get into today's deep dive, do you want to share that resource you were talking about earlier?
Oh, right, yeah. So for all the long-term investors tuning in, there's a really useful research platform called StockOracle. You can actually check it out through the special 14-day trial link we put down below in the description.
Yeah, it's pretty comprehensive, right?
It really is. I mean, it brings everything into one place. Company fundamentals, the OracleIQ stock appraisal, their OracleValue intrinsic value estimates. Plus it has like AI mode analysis, bull and bear insights, watch lists, portfolio tools, all of that.
Just a quick reminder, though, it can definitely help organize your research. But it is not financial advice. It's not a recommendation to buy or sell anything.
Exactly. And, AI analysis and valuation estimates, they can be incomplete or just wrong. And data might be delayed. So you always got to verify the important facts yourself and, make your own decisions.
Absolutely.
And just for full transparency, that is an affiliate link in the description. So we might earn a commission if you use it, but it's at no extra cost to you.
All right. So with that out of the way, I want to set a scene here because I'm kind of baffled by this one. Imagine you're running a business. Yeah. Right? And you just posted absolutely record-breaking revenue numbers.
So genuinely massive numbers.
Yeah. Your top line is surging by 45% compared to the same time last year. You're feeling, so incredibly confident about all these deals you're closing that you actually publicly raise your full-year financial forecasts.
Which is a bold move.
It is. You tell the world, hey, we expect to bring in anywhere from $230 million to $260 million. So naturally, you would expect the market to just stand up and applaud, right? Investors lining up around the block.
You'd think so.
But instead, the market's response is to just relentlessly slash your stock price by nearly 70% from its recent highs.
Okay.
That is the bizarre, just completely counterintuitive reality that SoundHound AI is living in right now.
It really is a massive structural disconnect because you have their Q2 2026 revenue hitting $61.9 million, which for them is just a fantastic number.
It's a huge beat.
Yeah, and when a management team raises forward guidance, especially in today's, rather unforgiving macroeconomic environment, that's a huge signal. I mean, they do not do that unless they have absolute visibility into their sales pipeline. Yeah. It essentially tells us the momentum isn't just a fluke.
I hear that, but look at the stock. It closed on August 24th at exactly $7. I mean, that's down roughly 44% over the last year, and it is a really painful 68% below its 52-week high, which was $22.17.
Steep drop, yeah.
So this massive gap between accelerating revenue and a completely beaten down stock price, that is the core tension we have to figure out in this deep dive today. Basically, is the market handing us this generational wealth building opportunity on a silver platter, or is the market actually completely right to be punishing this company?
Well, to figure that out, we really have to contextualize what kind of investment this actually is, because frankly, SoundHound is not for everyone.
No, definitely not.
If we're talking about portfolio construction, this fits squarely into a speculative, high-growth, high-reward profile. We're not analyzing some sleepy, stable utility stock that just pays out a predictable 4% dividend every year.
No, you're definitely not getting a safe dividend here.
Right. This is for long-term investors who are trying to capitalize on a massive multi-year systemic shift, specifically the adoption of AI automation in the enterprise space. Because voice AI isn't just a fun consumer novelty anymore.
Like asking your phone for the weather.
Exactly. It's not just a parlor trick. It is actively becoming core business infrastructure.
Okay, I hear the optimism, and obviously nobody is denying the massive macroeconomic trend of AI. That's real.
No.
But you know me, I am fiercely protective of capital, so I really have to push back on the practical side here.
Fair enough.
True wealth building, it isn't just about buying the most exciting tech narrative on the market. I mean, we've seen narrative bubbles burst way too many times.
We have.
Wealth building is about investing in companies that can safely compound shareholder value over time. You need a business that can actually survive long enough without bankrupting itself to deliver on that futuristic vision.
That's the key, yeah. Surviving to see the future.
Right. So my core question is whether SoundHound is a durable compounder or if it's just this highly volatile AI narrative play that's going to burn through all its cash and give long-term investors serious whiplash.
And that is exactly why we need to strip away the whole AI narrative entirely and just look under the hood at the raw fundamentals. If we want to know if it can compound value, we have to look at how they're actually making money.
Let's do it.
And on the surface, I gotta say, the bullish fundamentals are staggering. If we look at trailing 12-month revenue, they are growing at nearly 80%.
Wow. 80%.
Yeah. And let's be clear, you do not achieve 80% trailing growth without genuine product market fit. Corporate clients are aggressively buying what they're selling.
Okay, the top line is moving, no doubt about that. But honestly, anyone can grow revenue by 80% if they're handing out $1 worth of services for 50 cents.
Well,
Growth is easy, if you are willing to lose money on every single transaction.
which is why we have to look at the balance sheet next. And for a company at this specific growth stage, it's actually pristine.
Really? Pristine?
Yeah, they are carrying zero long-term debt as of the end of 2024, and they're sitting on $203.4 million in cash right now.
Okay, that is a nice chunk of change.
Right. In a world where capital is really expensive right now, having no debt obligations and a massive cash cushion, that's a major strategic advantage.
Having $203 million in cash is comforting, sure, but we really have to look at the mechanics of how they are spending it. Because when I look at the financials, this business, it kind of looks like they're building a massive private highway system.
How so?
Well, they're pouring tens of millions of dollars into the concrete, right? Training these specialized AI models, sending out sales teams to integrate them into complex client systems. And they're running at a massive loss today just so they can hopefully own all the toll booths tomorrow.
Right, the classic tech infrastructure play.
Exactly.
Yeah.
But my concern is that they might run out of concrete before the highway actually connects to the city.
You're talking about the cash burn, which is undeniably the primary tension in their financial profile.
It's severe. I mean, the trailing 12-month net margin is negative 91.84%.
Yeah.
And what really caught my eye is that in the first half of 2026, their operating cash flow actually worsened. It dropped to negative $60 million. So they aren't just burning cash, they're burning more cash than before to achieve that revenue acceleration.
The cash burn is very real, I won't deny that. But to build on your highway analogy, they are in the middle of an aggressive land grab phase for enterprise AI.
Right.
When a new technology market is forming this rapidly, companies often consciously prioritize grabbing market share over immediate profitability. I mean, they're spending heavily on R&D to refine their voice models and on sales and marketing to lock in these long-term enterprise contracts before their competitors do.
I understand the land grab logic. I really do.
Yeah.
But the mechanics of their profitability still worry me. Let's look at their gross margin. It sits at just 40.59%.
Yeah, that is on the lower side.
For our listeners, just to put that in perspective, a pure software as a service company, where you write the code once and you sell it 1 million times via the cloud, they typically have gross margins in the 70s or even 80s.
Right, highly scalable.
So a 40% margin tells me the mechanism of SoundHound's business is still very labor-intensive. They aren't just selling scalable software. They're likely doing heavy, customized implementation, dealing with hardware integration, or maybe paying significant licensing fees. That implies they have a long way to go before this becomes a beautifully efficient software machine.
That is a very sharp critique, and it's accurate. Their gross margin is significantly lower than typical pure SaaS peers because right now, their revenue mix really heavily relies on lower margin services just to get their tech into the door.
Exactly. Foot in the door costs.
But we have to acknowledge the trajectory here. Non-GAAP losses are reportedly narrowing.
Let's quickly define that for the audience because GAAP versus non-GAAP can be tricky to navigate.
Sure.
So GAAP is the strict, legally standardized accounting rules, which definitely show them deeply unprofitable. Non-GAAP is management's adjusted view, where they usually strip out non-cash expenses, like stock-based compensation for employees.
Yeah. Exactly. And while the strict GAAP unprofitability is severe, the sequential trends in their adjusted numbers show they are making real progress. They're starting to show the very earliest signs of operating leverage.
And just to clarify operating leverage, because it's a huge concept for wealth building, that's the holy grail, where a company finally covers all its massive fixed costs. So every new dollar of revenue that comes in starts dropping straight down to the bottom line as pure profit, rather than just paying to hire more engineers.
Right, exactly.
But because they are burning cash so quickly right now, they desperately need that leverage to kick in soon. Which means we need to understand what they're actually building with all this cash. Like, what are the actual growth engines that are supposed to justify this massive runway?
Okay, we can break their growth trajectory into three distinct areas. There's an existing engine, an emerging engine, and then a massive piece of optionality.
Okay, let's start with the existing engine.
So the existing engine is their OASYS platform. That's an agentic AI platform.
Let's pause on the jargon there. An agentic AI platform. For anyone who thinks that just sounds like another chatbot, what is the actual mechanism making this different?
It is a critical distinction to make because a standard chatbot is purely conversational. You ask it the weather, it tells you the weather.
Right.
But an agentic AI or an AI agent can actually take autonomous action. It can navigate a company's internal software system, pull relevant data, update a CRM, and execute complex workflows without a human pressing any buttons.
Oh, wow. Okay, that's different.
Yeah. And what makes SoundHound's OASI special is the incredibly intuitive voice interface layered over that capability. Management claims this specific platform is actively accelerating their deal cycles and significantly speeding up how fast they can onboard new customers.
Which makes perfect sense, actually, because in enterprise software, deployment friction is the enemy.
Oh, absolutely.
If a corporate client has to spend 6 months retraining their staff just to use your software, they won't buy it. But if they can just speak to it naturally to execute a workflow, you win the contract. So OESYS secures the software side.
Yep.
But I was looking at their recent deals, and they are pushing incredibly hard into healthcare, which to me feels like a massive pivot from their historical roots. I mean, they used to just be automotive dashboards and restaurant drive-thrus.
It is a pivot, but a really smart one.
Well, logically, yes. Because if you can get a hospital network to integrate your voice AI into their electronic medical records, the switching costs become completely insurmountable.
You've just perfectly identified the emerging engine. Breaking into the healthcare vertical expands their total addressable market exponentially.
I can imagine.
And like you said, the mechanics of healthcare revenue are entirely different from consumer tech. It is incredibly sticky, it's regulatory driven, requiring intense IPA compliance and complex medical terminology understanding.
Which is hard to do.
Exactly. Generic, off-the-shelf AI models really struggle with that level of specialization. Once SoundHound is integrated into a hospital network-sensitive workflow, they are essentially entrenched. I mean, a hospital is not going to rip out a compliant, functioning system just to save a few pennies.
Sticky, recurring revenue is exactly what you want to see if you're looking for a durable compounder. But you also mentioned a massive piece of optionality earlier. The wild card in all of this.
Yes, the pending LivePerson acquisition. This is expected to close in Q3 of 2026, and this is where the story gets really big.
Okay, lay it out for us.
This brings massive enterprise cross-selling opportunities. So LivePerson already has a huge established footprint in digital customer service and text-based chat across major global brands. By acquiring them, SoundHound can plug their specialized voice AI directly into LivePerson's existing client base.
Okay, I see the mechanical synergy there, but let me push back on the broader moat.
Go for it.
We have mega-cap tech giants, literal trillion-dollar companies, pouring tens of billions of dollars into AI infrastructure right now. If you are a hospital network or a massive retail brand, how defensible is SoundHound's position, really? What stops a mega-cap giant from simply bundling a quote-unquote good enough voice AI feature into their existing enterprise cloud software and crushing SoundHound entirely?
That is the ultimate existential question for literally any mid-cap AI company today.
Right.
SoundHound's defense is specialization. Their argument is that their proprietary technology, which they have been building from the ground up over many years specifically for complex multi-turn voice interactions, is highly tuned in a way that generalized large language models just aren't.
So it's purpose-built.
Exactly. They own their tech stack end to end. But you are absolutely right to question it. They have to continually prove that their moat is wide enough to keep the giants out.
And proving it requires hitting very specific milestones. If this company is going to survive the cash burn and fend off big tech, the market needs to see proof. So let's map out the catalyst timeline. What are the specific events that will force the market to wake up and reprice this stock, for better or worse?
Well, in the near term, all eyes are on the Q3 2026 close of that LivePerson acquisition.
Right.
This is what we call a step function catalyst. It's not a gradual increase, it's a structural leap. If this closes smoothly, management is officially targeting $350 million to $400 million in combined 2027 revenue.
Wow, okay.
Yeah, it completely alters the fundamental scale of the business virtually overnight.
That's the top-line dream for sure.
Yeah.
But what about the medium term? What are we watching in the next couple of earnings reports?
The medium term is all about the execution of that newly raised FY 2026 guidance, hitting that $230 to $260 million range. We'll get insight into that during the upcoming Q3 earnings. But crucially, sophisticated investors are going to look right past that top-line revenue beat. The sole focus will be on whether the second half operating cash burn finally starts to decelerate.
Because if they hit the $260 million revenue target, but they burn another $70 million in cash doing it, institutional money will absolutely punish them. Revenue growth means nothing, absolutely nothing, if the mechanics of that growth accelerate your path to bankruptcy.
Couldn't agree more.
So near term is the merger, medium term is cash control. What proves the long-term thesis?
The long-term catalyst is the actual disclosure of tangible adoption metrics for the OASYS platform. Right now, we hear a lot of qualitative commentary on earnings calls about how great it is.
Lots of happy talk.
Exactly. But the market needs to see real quantitative data, customer counts, deal velocity, and exactly how much revenue the platform is actually contributing. If they release concrete numbers proving that product market fit is translating into high-margin software revenue, that triggers a major upward re-rating of the stock.
So with a combined 350 to 400 million revenue target looming in 2027, we have to talk about what price we are paying for that future today. Let's look at valuation. Because even with the stock down so much, this isn't exactly a bargain bin value play.
No, it is definitely not. Currently, they are trading at a price-to-sales multiple of 17.7x.
And I cannot stress enough how much caution that requires. A 17.7x sales multiple means you are paying roughly $18 for every single dollar of revenue they generate.
It's steep.
It is a highly demanding valuation, especially for a company that has no clear, immediate path to GAAP profitability yet. When you pay 17 times sales, you're pricing in perfection.
You are.
Any slight slip in execution, any integration headache with a live-person merger, and that multiple can contract violently. We've seen software multiples compress from 17x down to 5x in the blink of an eye.
The valuation is undeniably rich on paper, I'll give you that. But I counter with the reality of the price action. Expectations have already been severely reset by the market. I mean, the stock is sitting 68% below its 52-week high.
True, a lot of froth is gone.
Exactly. A massive amount of that blind early AI euphoria has been completely drained out of the share price. The market has already baked in a heavy dose of skepticism regarding their cash burn. So if management can just demonstrate that operating leverage we talked about earlier, just proving that revenue is finally growing faster than their operating expenses, the current valuation could easily be justified by the sheer scale that the live-person merger brings.
Okay, but if the valuation is demanding perfection, are the big institutional players actually buying that perfection right now? Like, what is the smart money doing? Let's check the technicals and the sentiment.
Right now, the price structure shows the stock is forming a short-term base. It's trading right around that $7 mark, which actually puts it just above its 20-day moving average of $6.90 and its 50-day moving average of $6.71.
Okay, so it's holding above the short-term lines.
Yeah, and for algorithmic and technical traders, finding support above those short-term averages suggests that the acute panic-selling pressure has paused. It's stabilizing.
But those are very short-term indicators. What about the broader trend?
The longer-term trend is still problematic. It is trapped well below the 200-day moving average, which is sitting way up at $8.63. So the primary downward trend hasn't officially reversed yet. Furthermore, the relative strength index, the RSI, is completely neutral at 56.3. It is neither overbought nor oversold.
Which perfectly aligns with the fundamental story. The market is in a strict wait-and-see posture. I mean, analysts might be publishing these reports about huge upside based on the revenue beats, but the real-world institutional capital is sitting on the sidelines.
They're being cautious.
Right. They see the $203 million in cash, they see the $60 million cash burn, and they're waiting for proof that the company won't run out of money before the live-person synergy actually kicks in.
That's exactly it. Capital preservation comes first for institutional managers. And, we always remind listeners, technical analysis shows historical probabilities never guarantees. A base of support at $7 can just as easily break down as it can break out depending on the very next earnings print.
Which brings us to the most important part of capital preservation. Okay. Understanding exactly what could go wrong. That hesitant market sentiment exists for a very good reason. We need to clearly define the bear case. What are the specific threats that could completely break this bullish thesis and wipe out a long-term investment?
The three most critical threats here are execution risk, M&A integration risk, and margin pressure.
Okay.
Let's start with execution risk, specifically regarding the cash burn you highlighted earlier.
Yeah, and I'm going to drive the mathematics of this home for anyone listening. Their first half 2026 cash burn was 37% worse than the first half of 2025.
It accelerated.
Exactly. If that operating cash burn crosses $70 million in the second half of this year, they are going to rapidly eat through that $203 million cash pile. I mean, if they burn $140 million a year, they have less than 18 months of runway left.
Which is not a lot of time in the corporate world.
No. And the mechanics of running out of cash are brutal. They will be forced to raise capital just to keep the lights on. If they have to issue millions of new shares while the stock is depressed at $7 or lower, that results in highly dilutive capital raises.
Right.
It artificially inflates the share count, meaning the slice of the pie that you as an existing shareholder own becomes significantly smaller and less valuable.
I agree completely. Unchecked dilution is the absolute ultimate enemy of the long-term investor. It destroys wealth, even if the company eventually succeeds.
Exactly.
Then we have the M&A risk. LivePerson is not a small bolt-on acquisition. It is a massive integration project. Mergers and acquisitions notoriously fail at a high rate.
They really do.
If they fail to integrate the two differing corporate cultures, or if they struggle to merge the technology stacks, or if they just completely miss those combined revenue targets, the thesis fractures, you essentially take on all the structural headaches of a merger without reaping any of the financial rewards.
And finally, the margins.
Right. If those gross margins slip below 40%, like if they have to discount heavily to win deals, or if integration costs spike, the dream of achieving highly profitable software-like margins dies. I honestly acknowledge the severity of the downside here. If their organic revenue growth starts to decelerate before they get that cash burn under strict control, the entire wealth-building thesis falls apart.
Okay, we've stress-tested the downside, so now let's balance that by looking at the ceiling. If management navigates these threats perfectly over the next few years, what does the business look like? Let's sketch out a 3 to 5 year blue sky scenario. And we must explicitly state for the audience, this is an optimistic best case scenario. It is absolutely not a prediction.
Fair warning. So, in a flawless execution scenario over the next 3 to 5 years, the OSYS platform achieves massive widespread enterprise adoption. It proves its value and accelerates deal cycles across multiple industries. The LivePerson acquisition integrates seamlessly. They easily hit that 2027 $400 million combined revenue target, and they unlock deep, highly profitable cross-selling loops between text-based chat and voice AI.
And mechanically, what does that do to the financials?
Well, the healthcare vertical scales up into a major sticky pillar of regulatory-driven recurring revenue. As those higher-margin software platform subscriptions become the majority of their revenue mix, the overall gross margins expand from 40% up toward traditional SaaS levels of 70% or more.
That's the dream.
Right. The operating leverage finally kicks in, meaning revenues soar while fixed costs stay flat and the company approaches and then crosses GAAP break-even. In this blue sky scenario, SoundHound transitions from being a speculative, cash-burning AI narrative into a deeply entrenched, self-funding enterprise AI giant.
So putting everything on the table, balancing that immense blue sky potential with the very real immediate mathematical risk of running out of cash, what is our wealth-building verdict?
Synthesizing all the research, the overall rating lands at a 6 out of 10.
Okay, a 6.
Yeah, that is neutral, but leaning slightly constructive. The strongest long-term driver is undeniably the LivePerson acquisition, which gives them the scale to literally double their revenue trajectory.
But the biggest threat blocking that path is the accelerating operating cash burn, consuming their financial runway before they ever get there.
Yeah.
So comparing the two paths forward, the base case is a strict wait and see on cash flow in the upcoming Q3 earnings. The blue sky case is flawless execution, leading them to become a self-funding enterprise AI platform.
Exactly. It presents a truly fascinating opportunity for a speculative investor who has high conviction in the long-term voice AI tailwind and can stomach the volatility. But cautious investors, particularly those focused on capital preservation and compounding, should absolutely wait for tangible proof of margin expansion and cash flow control before taking position.
Makes a lot of sense. Hey, if you want to dive deeper and organize your long-term stock research in one place, you can check out StockOracle through the special 14-day trial link below in the description. It combines company fundamentals, valuation estimates, AI bull and bear insights, moat analysis, comparisons, watch lists, and portfolio tools.
Just remember, it is a research platform, not financial advice or a recommendation to buy or sell.
Right.
AI insights and valuation estimates may be wrong, so always verify important information and make your own independent decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this discussion helped you better understand the mechanics of the market, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Wait, I actually have one last thing.
Oh, go ahead.
But before we go, I want to leave you with one final thought to chew on. We spent this entire time analyzing their software margins and cash burn rate. But what if the software itself isn't the real prize? SoundHound is processing millions of complex, industry-specific conversational interactions every single day. In drive-thrus, in cars, in hospitals. In an AI arms race, highly specialized proprietary data is more valuable than oil.
Oh, that's a good point.
Even if they struggle to reach profitability as an independent software company, does that massive, ever-growing corpus of real-world voice data make them an undeniable, irresistible acquisition target for one of the trillion-dollar tech giants? Think about who really controls the data, and you might see the future of the company in a totally different light.